Welcome back! In the previous video, we held a discussion on the advantages of a publicly listed company as opposed to a private one. In this second part, let's continue with the disadvantages. So in the previous video, and allow me to go back so you can see what I'm talking about. On this point, we said that going public can increase the company's credibility due to the greater number of disclosures the company will be subject to in order to meet the regulatory and reporting requirements that being a public company entails. But there are costs, monetary and otherwise, associated with these disclosures, with regulatory and reporting requirements. So going back to our discussion on disadvantages, there are significantly more regulatory and reporting requirements for a public company to meet than is the case for a private one. In case you are wondering, the reason for this has to do with the fact that the regulatory and supervisory authorities feel that the general public should be protected from corporate wrongdoings. On the other hand, investors in private firms are not subject to the same level of regulations because they are generally perceived to be sophisticated enough to understand the potential risks involved in their investments. And as was stated before, these additional requirements translate into higher costs for the firm than what would be the case if it were a private one. Some of these costs, such as the costs associated with carrying out the IPO, are one-off costs, but others, such as the preparation of periodic reports, are recurring. Also, and again within the same point, the associated disclosures, although they can help enhance the company's credibility, they also have their downside. Information that could offer advantages to the company relative to its competition might now be readily available to its competitors. Sometimes, some level of secrecy, although coming at a cost of reduced transparency, might be beneficial. A lot of times, though, the reporting requirements imposed on public companies do not allow them to maintain that desired level of secrecy. Now, if we were to revisit our advantages, we would remind ourselves that going public can offer potential marketing advantages that can enhance the company's competitive position. Wait a minute. Didn't we just say that extensive disclosures can divulge valuable information to competitors? Aren't the two conflicting? What I'm trying to make you realize by posing this question is that a lot of times companies need to weigh potential competitive advantages against disadvantages and try to identify whether there is a net benefit or net loss involved. Doing that is not always straightforward, as there are certain factors that cannot easily be quantified. In those cases, direct comparison is difficult. After this comment, let's continue with our disadvantages. Our second point over here, which in a way is related to the first one, deals with an issue that's been creating heated discussion for a number of years, even decades, and it's been fairly recently termed quarterly capitalism. This has to do with the corporate culture that's developed in public firms that does not focus on long-term sustainable growth of the business, but instead focuses on short-term results. So this has to do with promoting what is called short-termism. The reason it is called quarterly capitalism has to do with the fact that in a number of countries, including the United States where this term was coined, publicly listed companies are obliged to file quarterly reports with regulatory authorities. In doing so, they get obsessed with meeting quarterly goals, short-term goals, and that's why the term short-termism, if it's not already obvious. So as I was saying, corporations get obsessed with meeting quarterly goals that, if not met, will negatively affect the stock price and as a result might disappoint shareholders. One such goal has to do with quarterly earnings. So this short-term corporate thinking is fixated on the stock price and engaging in those actions that will artificially pump up the stock price, instead of focusing on those activities that will lead to long-term growth, such as investing in new technologies and research and development. And this type of behavior can be detrimental for the company's future prospects. Now, if we were to see things from the perspective of private firms, they don't have an obligation to file quarterly reports with regulators, nor do they need to worry about fluctuating stock prices, as their stock is not listed on public stock exchanges. Therefore, the management team of a private firm doesn't have the pressure to perform on a quarterly basis, and it can instead focus on growing the firm for the long term. I will close this video with the following. The discussion in these last two videos on both the disadvantages as well as the advantages of being a public firm could have been taken at much greater lengths. We will get into considerations that weren't mentioned over here in due time. The main reason I didn't cover them here is to avoid unnecessary confusion. Take care.